Day trading or swing trading? Same charts, opposite trade-offs. Which one fits your life? Let's break it down.
A day trader closes everything before the bell. A swing trader holds for days, sometimes weeks. That single rule, when you exit, changes every other piece of the puzzle. The capital you need, the hours you'll burn, the cost you'll pay, the psychological load you'll carry. And here's the part most people miss. On the same currency pair, in the same account, with the same capital, the day trader pays the broker roughly 12 times more per month before either trader has been right or wrong about the market. Keep that number in mind. It comes back at the end. So what does each style actually do? A day trader scans short-term price patterns, opening range breakouts, gap fills, volume thrusts, reversals into round numbers. Trades last seconds to a few hours. There's no overnight risk and no time for a thesis to develop slowly either. You're paid for being right inside one session. That's it. A swing trader works the same charts on a daily time frame. The setup is a pullback to a moving average, a breakout from a multi-week base, a sentiment extreme, entry near a pivot, then hold for 2 days to 2 weeks while the move plays out. You take overnight gap risk in exchange for not living in front of a screen, and in exchange for catching much bigger per trade moves. Neither is investing. Both are short-term tactical trading. The only structural difference is whether you're paid for intraday or interday moves. That sounds neutral. The time commitment is not. Day trading needs 4 to 6 hours of focused screen time during the session. Pre-market scan, the opening drive, the midday flat zone, often a break, then the close. You cannot run it from a Zoom meeting. The job is the session. Swing trading inverts the schedule. 30 to 90 minutes a day, almost all of it after the close or before the open. Daily chart review, setting alerts, sizing for the next day's possible entries. A surgeon, a teacher, anyone on a fixed weekday. You can run a serious swing portfolio without ever watching a tick during the day. So the first filter is brutal. If your day already has 8 productive hours in it, day trading is not a part-time pursuit. The half hour around the open and the last hour before the close are where most of the day's edge lives. Those windows are non-negotiable. You either have them free or you don't. Okay, time, brutal. Now the capital side. And in the US, this isn't a preference, it's a rule. FINRA's pattern day trader rule. Place 4 or more day trades inside 5 business days in a margin account and the broker flags you. A flagged account must hold at least $25,000 in equity at all times to keep day trading. Below that line, day trades freeze for 90 days. Swing trading sidesteps the rule completely. Hold overnight, it's not a day trade. You can swing trade US stocks with $3,000 in a cash account at Robinhood or Schwab indefinitely. Outside US equities, the picture changes. Futures, no PDT rule. Micro contracts like MES and MNQ let you day trade with a few $1,000s at NinjaTrader or Tradovate. Forex and CFDs, no PDT rule either, but the regulators are clear. 70 to 85% of retail CFD accounts lose money. Crypto, 24/7, no rule, either style works. So if you're under $25,000 and want US stocks, swing trading is the structurally accessible choice, full stop. Day trading at that budget pushes you into futures or forex. Each one's a separate learning curve. Now the part I flagged at the start. Every trade carries a spread, sometimes a commission. The bill scales with frequency. On a one-lot Euro-US dollar trade with a raw spread broker, the all-in cost is around $7. Trade 5 times a day, 20 days a month, the broker collects roughly $700 a month before you've made or lost a cent on direction. The swing trader taking 8 trades a month on the same pair pays around $56. Same broker, same pair, same capital. One pays 12 times more. That's not the broker being greedy, that's frequency math. The day trader can absolutely overcome it, but only with an edge sharp enough to beat the spread bill 10 or more times a month. The swing trader's bar is lower because they pull the trigger less often. That doesn't mean swing trading is better, it means the day trader needs a much sharper edge just to break even on costs. That's the cost side. The psychology side is where most accounts actually die, and the two styles fail in opposite ways. Day traders blow up by overtrading, chasing setups that aren't there, revenge trading after a loss, exhausting their decision capacity by 11 a.m. and then making one bad call at lunch that wipes the week. Swing traders blow up by holding losers too long, anchoring to the entry price, watching a position grind against them for 3 days and freezing, cutting winners early because the gain feels fragile. Here's the honest test. If you cannot let a position run for an hour without checking it 20 times, swing trading will be torture. If you cannot make 10 decisions in an hour without your judgment degrading, day trading will burn you out. The temperament is non-transferable. You don't grow into the wrong one, you just lose money slower. One more thing on the math, because the win rate shapes look completely different. Day traders typically run a 50 to 60% win rate, with the average win roughly equal to the average loss. High trade count, smoother equity curve, but transaction costs eat heavily. Swing traders run 35 to 45% win rates, with the average win 2 to 3 times the average loss. Lumpier returns. 1 or 2 big winners often make the month. Both work mathematically. A 55% win rate at 1R has the same expectancy as a 35% win rate at 2.5R. What kills accounts isn't picking the wrong shape, it's paying transaction costs while running a strategy that has neither shape working in its favor. So who picks which? Here's the honest filter. Do you have 4 free market hours every weekday? If no, you swing trade. There's no part-time day trading at a serious level. Don't pretend otherwise. Is your capital under $25,000 and you want US stocks? You swing trade in a cash account. Day trading at that size pushes you into futures or forex. That's fine, but it's a different game with a different learning curve. Can you make 30 decisions in a day without your judgment degrading? If no, swing trade. The cognitive load is real. Can you sit through a 5% adverse move overnight without panic? If no, day trade. Gap risk will shake you out. And remember the cost number from the start, 12 times. That's what the day trader pays the broker on the same capital before any directional bet pays off. That's not a reason to avoid day trading, it's a reason to never start it without an edge sharp enough to clear that bill, and the hours, capital, and temperament to actually run it. Pick the one that fits your life, then build the edge to match.
Day trade if you have hours and capital. Otherwise, swing trade. Full breakdown linked in the description.